Something extraordinary is happening in the precious metals market right now, and if you're not paying attention, you're about to miss the most significant wealth transfer opportunity of this decade. We're witnessing what financial historians will look back on as the turning point, the moment when the old monetary system finally cracked and gold emerged as the undisputed winner in the global wealth preservation game. Let me show you exactly what's unfolding behind the scenes, because what the mainstream financial media isn't telling you could be the difference between protecting your wealth and watching it evaporate in the coming economic storm. The signs are everywhere if you know where to look. And the smart money, the central banks, the billionaires, they're already positioning themselves for what comes next. Gold has broken through critical resistance levels that technical analysts have been watching for years. We're seeing price action that mirrors some of the most explosive bull markets in precious metals history, but this time there's something different, something more fundamental driving this move. This isn't speculation. This isn't retail investors chasing momentum. This is institutional accumulation on a scale we've never witnessed before. Central banks around the world are buying gold at a pace that would have been unthinkable just a few years ago. We're talking about hundreds of tons being purchased quarter after quarter with no signs of slowing down. China's central bank has been adding to its reserves month after month. The People's Bank of China isn't doing this because they think gold is a nice shiny metal to look at. They're doing it because they understand what's coming for the US dollar's role as the global reserve currency. Think about what that means for a moment. These are the institutions that have access to the best economic data, the most sophisticated forecasting models, teams of PhDs analyzing every aspect of the global financial system. And they're choosing to convert their dollar reserves into physical gold, not gold ETFs, not gold futures, physical metal that they're storing in their own vaults. The BRICS nations, Brazil, Russia, India, China, and South Africa, along with the dozens of countries now joining or seeking to join this alliance, are actively working to create alternative payment systems that bypass the dollar entirely. They're settling trade in their own currencies. They're building new financial infrastructure. And at the center of it all is gold. Gold is the neutral reserve asset that no single country controls. Before we go further, I want to make sure you have access to the free guide I put together. It's in the description below. Thousands of American retirees are using the strategies in this guide to protect their hard-earned wealth from what's happening in the markets right now. It's completely free, just check the description. Now let's talk about what this de-dollarization trend really means for your wealth. For decades, the US dollar has been the world's reserve currency. Countries needed dollars to buy oil, to settle international trade, to hold as reserves. This created constant demand for dollars, which allowed the United States to run massive deficits without immediate consequences. But that system is breaking down right in front of us. When countries no longer need to hold as many dollars, when they can settle trade in yuan or rupees or their own currencies, what happens to all those excess dollars floating around the global financial system? They come home. And when they come home, they create inflation. Not the transitory inflation that central bankers kept promising us, but the kind of persistent, structural inflation that erodes purchasing power year after year. This is why gold is moving. It's not just a hedge against inflation. It's a hedge against the entire monetary system that's been in place since the Bretton Woods Agreement collapsed back in 1971. That was the moment when President Nixon closed the gold window, when the dollar stopped being backed by anything except the full faith and credit of the US government. And for 50 years, that faith and credit was enough because there was no alternative. But now there is an alternative. Multiple alternatives, actually. And the world is watching the United States weaponize the dollar through sanctions, freeze foreign reserves, and print trillions of new dollars to fund deficit spending. Every country watching this is asking themselves the same question. Could this happen to us? Could our dollar reserves be frozen or devalued overnight by political decisions in Washington? That's why they're buying gold. Gold can't be printed. Gold can't be frozen by executive order. Gold has been money for 5,000 years, and it will still be money long after today's fiat currencies are forgotten. Let's look at the technical picture for a moment, because what's happening on the charts is just as compelling as the fundamental story. Gold has broken out of a multi-year consolidation pattern. We're seeing higher highs and higher lows, the classic signature of a bull market. But more importantly, we're seeing the kind of steady, grinding upward movement that suggests institutional accumulation rather than speculative mania. The gold to silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, has been compressing. Historically, when this ratio falls, it signals that silver is outperforming gold, which typically happens in the later stages of precious metals bull markets, when industrial demand combines with investment demand to create explosive price moves. And speaking of silver, we need to talk about what's happening in that market, because it might be even more dramatic than gold. Silver is facing a structural supply deficit that's been building for years. The Silver Institute's data shows that industrial demand for silver has been exceeding mine supply, and that deficit is growing. Why? Because silver isn't just a monetary metal anymore. It's a critical industrial commodity that's essential for the green energy transition. Every solar panel requires silver. Electric vehicles use significantly more silver than traditional cars. 5G infrastructure, medical devices, water purification systems, the list goes on. And unlike gold, where most of the metal ever mined still exists in some form, silver gets consumed in industrial applications. It's used up, dispersed, economically unrecoverable. The solar industry alone is projected to consume massive amounts of silver over the next decade as countries race to meet their renewable energy targets. China is building solar capacity at a pace that's hard to comprehend. The United States, Europe, India, they're all ramping up solar installations, and every single panel needs silver. Meanwhile, silver mine production isn't keeping pace. Most silver comes as a byproduct of mining other metals like copper, lead, and zinc. You can't just decide to mine more silver when the price goes up. The supply response is slow and constrained by the economics of the primary metals being mined. This creates a situation where industrial users are competing with investors for a shrinking pool of available silver. And when you have structural deficits year after year, eventually something has to give. Either the price rises enough to ration demand, or you get physical shortages. We're already seeing signs of tightness in the physical market, with premiums over spot price remaining elevated and delivery times stretching out. Now here's where it gets really interesting for anyone thinking about their retirement security. The traditional 60-40 portfolio, 60% stocks and 40% bonds, that model is broken. We've just lived through a period where both stocks and bonds fell simultaneously, something that wasn't supposed to happen according to modern portfolio theory. The negative correlation between stocks and bonds that investors relied on for diversification disappeared when inflation showed up. Gold, on the other hand, has maintained its role as a portfolio diversifier. When stocks fall, gold tends to hold its value or rise. When inflation accelerates, gold protects purchasing power. When geopolitical tensions flare up, gold acts as a safe haven. It's the one asset that doesn't depend on someone else's promise to pay, that doesn't have counterparty risk, that can't be inflated away by central bank policy. This is why more and more financial advisors are recommending that clients hold a meaningful allocation to physical precious metals. Not paper gold, not mining stocks, but actual physical metal that you own outright. Because in a real crisis, when the financial system is under stress, the difference between owning a claim on gold and owning physical gold becomes very important very quickly. Think back to 2008 during the financial crisis. Remember how quickly things unraveled? Bear Stearns collapsed over a weekend. Lehman Brothers went from a blue-chip investment bank to bankruptcy in a matter of days. Money market funds broke the buck. The entire commercial paper market froze. If you had your wealth tied up in the financial system in counterparty-dependent assets, you were at the mercy of whether those institutions survived. Physical gold and silver don't have that risk. They're not someone else's liability. They don't depend on a bank staying solvent or a government making good on its promises. They're real assets that have held value through every financial crisis, every currency collapse, every period of economic turmoil in human history. And we're heading into a period that could make 2008 look like a minor correction. The debt levels are higher now, much higher. Government debt, corporate debt, consumer debt, all at record levels relative to GDP. The Federal Reserve's balance sheet is still massively expanded from all the quantitative easing programs. The banking system is sitting on hundreds of billions in unrealized losses from bonds purchased when interest rates were near zero. Quick aside here, if you're sitting on $100,000 or more in retirement accounts, I put together a comprehensive guide on how gold IRAs work. It's in the description. It covers exactly how you can get physical gold into your retirement account without triggering tax penalties, how the process works, what the costs are, all the details you need to make an informed decision. This is especially relevant given everything we're discussing about market instability and the need to protect retirement wealth. Worth checking out if that applies to your situation. Now back to what's happening in the broader economy. We're seeing cracks appear in the commercial real estate market. Office buildings in major cities are sitting empty as remote work becomes permanent. The valuations on these properties are falling, which means the loans secured by these properties are underwater. Regional banks, the ones that did most of the commercial real estate lending, are sitting on portfolios of troubled loans that could start defaulting in waves. The residential real estate market is frozen. Prices are still elevated, but transaction volume has collapsed because existing homeowners are locked into low mortgage rates and can't afford to move. First-time buyers are priced out of the market. The only thing holding prices up is the lack of inventory, but that's not a healthy market. That's a stalemate waiting to break. Consumer savings rates have plummeted. Credit card debt is at record highs. Delinquencies are rising. The pandemic-era savings have been spent. The student loan payment pause has ended. The average American household is more financially stretched than at any point in recent history, and that's with unemployment still relatively low. What happens when the job market softens? Corporate profit margins are under pressure from higher labor costs, higher input costs, higher interest expenses on all that debt they took on when rates were zero. Companies that looked financially solid when they could borrow at 2% look very different when they have to refinance at 7 or 8%. We're going to see a wave of corporate distress as this debt maturity wall hits over the next few years. And through all of this, what's the Federal Reserve's response going to be? They're trapped. If they keep rates high to fight inflation, they risk triggering a deep recession and a cascade of defaults across the economy. If they cut rates and restart quantitative easing to support the economy, they risk reigniting inflation and further undermining confidence in the dollar. This is the impossible situation that central banks have created through decades of monetary manipulation. They've pushed problems into the future with each round of stimulus, each rate cut, each quantitative easing program. But you can't push problems into the future forever. Eventually, the future arrives, and all those accumulated imbalances have to be resolved. Gold and silver are telling us that the market understands this. The steady accumulation we're seeing, the breakouts to new highs, the persistent strength despite rising interest rates, all of this is the market pricing in the reality that the current monetary system is unsustainable. Let's talk about what happened in the 1970s, because there are some striking parallels to today. That decade started with the end of the Bretton Woods system, the closing of the gold window. It featured persistent inflation, energy crises, geopolitical instability, and a loss of confidence in government institutions. Sound familiar? Gold started that decade trading around $35 an ounce. By the end of the decade, it had peaked above $800. That's more than a 20-fold increase. Silver went from around $1.50 to over $50. The gains were life-changing for people who recognized what was happening and positioned themselves accordingly. But here's what's different about today. In the 1970s, the problems were largely confined to the United States and the Western world. Today, we're dealing with a global debt bubble, a global currency crisis, a global loss of confidence in fiat money. The scale is bigger, the interconnections are deeper, the potential for systemic breakdown is greater. And unlike the 1970s, when Paul Volcker could raise interest rates to 20% to break the back of inflation, today's debt levels make that impossible. Raising rates to 20% would bankrupt the government through interest payments alone. It would trigger a deflationary collapse that would make the Great Depression look mild. Central banks don't have the same tools they had back then. This is why the smart money is accumulating gold and silver now, before the crisis fully unfolds. They're not waiting for confirmation. They're not waiting for the mainstream media to tell them it's safe to buy. They're looking at the fundamentals, looking at the debt levels, looking at the monetary policy constraints, and they're positioning themselves for what comes next. The gold market is also benefiting from a shift in how investors think about portfolio construction. For years, The conventional wisdom was that gold was a non-productive asset, that it didn't generate cash flow, that you were better off in stocks or real estate. But that thinking assumed that the financial system was stable, that currencies maintained their purchasing power, that counterparty risk was minimal. Those assumptions are being questioned now. Investors are realizing that having some portion of your wealth in an asset with no counterparty risk, that can't be debased by monetary policy that has maintained its purchasing power over centuries. That's not a drag on your portfolio, it's insurance. And insurance has value, especially when the risks are rising. The institutional adoption of gold is accelerating. Pension funds, sovereign wealth funds, family offices, they're all increasing their allocations. These are sophisticated investors with long-time horizons who are looking at the same data we're discussing and reaching the same conclusions. The monetary system is unstable. Fiat currencies are being debased. Real assets are going to outperform financial assets over the coming decade. Silver offers even more upside potential because of its dual nature as both a monetary metal and an industrial commodity. When investment demand and industrial demand both surge at the same time, the price moves can be explosive. We saw this in 2011 when silver briefly touched $50 an ounce. We saw it in 1980 when the Hunt brothers tried to corner the market. And we're setting up for another one of those moves now. The supply-demand fundamentals for silver are more compelling than they've been in decades. The structural deficit is real and growing. The industrial applications are expanding. The investment demand is building. And the above-ground inventories that could buffer supply shortages are being drawn down. At some point, the market is going to have to reprice silver significantly higher to balance supply and demand. What does this mean for you, for your retirement, for your family's financial security? It means that having exposure to physical gold and silver isn't speculation, it's prudent risk management. It's recognizing that the world is changing, that the monetary system we've lived under for the past 50 years is reaching its limits, and that you need to protect your wealth from what comes next. The beauty of gold and silver is that they're not all or nothing bets. You don't have to believe that the entire financial system is going to collapse tomorrow to justify owning them. Even in a scenario where things muddle through, where we have persistent inflation but avoid outright crisis, gold and silver will preserve your purchasing power better than cash or bonds. And if things do get worse, if we do see a currency crisis, or a financial system breakdown, or a loss of confidence in government debt, then having a meaningful allocation to physical precious metals could be the difference between maintaining your standard of living and seeing your wealth evaporate. This isn't about fear-mongering. This is about looking at the data, understanding the trends, and making rational decisions about how to protect what you've worked your whole life to build. The central banks are buying gold for a reason. The billionaires are buying gold for a reason. The sovereign wealth funds are buying gold for a reason. They see what's coming. The question is, are you going to wait until everyone else figures it out, until the price has already moved significantly higher, until physical metal becomes hard to source? Or are you going to position yourself now while you still can, while premiums are reasonable, while the opportunity is still in front of you? The turning point for global wealth is here. The old monetary order is breaking down. The new order that emerges will be built on real assets, on sound money, on things that can't be printed or manipulated by central banks. Gold and silver are going to play a central role in that new order, just as they have throughout human history. The institutions know this. The central banks know this. The question is, do you know this? And more importantly, are you going to act on it? For those of you who've watched this far, I want to make sure you know about the exclusive opportunity available to you. In the description, there's information about a one-on-one educational web conference that's completely free and no obligation. This is specifically for American retirees with at least $100,000 in any retirement account. If you mention that you watched this video all the way through, you'll get access to this exclusive consultation where we can discuss your specific situation and how precious metals might fit into your overall retirement strategy. This isn't available to everyone, just to serious investors who are taking the time to educate themselves about what's happening in the markets. The wealth transfer that's coming is going to be massive. Those who understand what's happening and position themselves accordingly are going to preserve and grow their wealth. Those who don't, who keep their heads in the sand, who trust that the system will somehow fix itself, they're going to be on the wrong side of this transfer. Gold wins. It's won every time throughout history when fiat currencies have been debased, when governments have overspent, when central banks have printed too much money. This time is no different. The only question is whether you're going to be positioned to benefit from it, or whether you're going to be one of the people wondering what happened to your purchasing power, your retirement security, your financial future. The choice is yours. The information is here. The opportunity is now. What you do with it will determine how you weather the economic storm that's building on the horizon.